Today I'm joined by Andrew Cowley, the Managing Partner at Impact Healthcare REIT. Andrew, great to have you with us.
Thank you.
So please talk us through how the first half of this year went for the company.
I think it's been a pretty interesting time with inflation coming down less quickly than some people thought it might, and interest rates going up more than expected as a result of that. And so we can all agree, I hope, it's been a pretty challenging time. And against that backdrop, we're really pleased with how well the business has done and showed its continued inbuilt resilience. So our profits for the first 6 months of the year were up slightly on the same period last year. We grew our rent roll by just over 10% from £43 million at the beginning of the year to 48 million at June. Part of that rent increase came from rent reviews. 100% of our leases are inflation linked. And those rent reviews in turn help the independent valuation of our property portfolio grow by 2.4%. And that enabled our NAV per share to grow from 110p at the beginning of the year to 114p in June. So this pretty solid financial performance is what's enabling us to deliver one of our main strategic objectives, and that's to pay a progressive dividend, which is covered by earnings per share.
Now, you mentioned the rise in interest rates. How has that rise changed how you think about your balance sheet?
So I mentioned the importance of dividend policy in our strategy. As important as strategy is having a solid and conservative balance sheet, so we can live through the rough weather we're currently all having to cope with. Our LTV at mid-year was 29%, and we did a lot of stress testing to make sure that we can cope with interest rates going significantly higher than the markets are currently predicting they will. The other thing we did during the first half of the year was work with our lenders wherever possible to extend our maturities. So we repaid our Metro Bank facility in full. It was our most expensive piece of debt at 265 basis points over. We replaced that by extending the size of our NatWest facility from 26 million to 50 million, on which we paid 200 basis points, but also increasing its maturity by 4 years from 2024 to 2028. And we increased the maturity of our HSBC facility by 1 year to 2026. So today we have no debt falling due between now and 2026. We have £59 million of headroom of undrawn debt on our facilities, and we have £22 million of cash on our balance sheet. So we've got dry powder. One other thing I should mention regarding the balance sheet is we had an interest rate option which expired in June, and that reduced the level of our hedged debt from 80% to 66%. We didn't immediately replace that option because option pricing in June we thought was extremely high, following a very disappointing May inflation number. Option pricing is now settled back. We now think at more reasonable levels, and we're looking at ways to increase our hedged debt at the moment.
Now, Andrew, with wage and cost increases, that must be putting pressure on your tenants. How are they coping?
I think that's probably the single most important question. The short answer is pretty well in the circumstances. So we want our tenants to have good financial performance because that's what makes their care sustainable, enables them to focus on improving and delivering good quality care. Our tenants' financial performance has 3 main drivers. The first is occupancy, how many beds in the homes they rent from us are occupied, the fees they charge for the care they provide, and staff wages, because wages are by far their biggest cost item. So what we saw in the first 6 months of this year was occupancy continuing to recover from its COVID lows. It was 87% at the beginning of the year, 89% in July. Average weekly fee growth in 2022 was good. It accelerated in the first half of 2023. So in the 12 months to June this year, the fees our tenants charge rose by 15%, an average of 15%, compared to 13% increase in the 12 months to December. The amount they pay their staff also increased by 12%, and I think you can read 3 things into that. First, although costs are going back up, they're not cutting back on the care they provide. They are increasing staff wages, and those wage increases are affordable because they're lower than the fee increases. One other thing I should mention on our tenant staffing is we saw agency staff really spike up last year. All our tenants having trouble finding permanent staff. Agency staffing is coming back to more normal levels, and that's a good thing. Not just about saving money, but agency staff, you can reduce care quality because people are coming and going. So that's a very encouraging sign, seeing agency staff coming back to more normal levels. So what all this translates into is stable rent cover across our portfolio. If you look at the 4 years, 2019 to 2022, so 1 normal year, 2 years of pandemic, 1 year of rapidly rising inflation, our average rent cover was 1.8 times. In the first 6 months of this year, it was slightly above 1.8 times. So it's stable through these very volatile times.
So let's now talk a little bit more about your ongoing growth strategy.
Well, we operate in this extremely fragmented market, and we own slightly less than 2% of that market. So over the medium longer term, we're really confident there'll be attractive opportunities for us to grow. And we're also very confident that the long-term drivers of that market, created by an aging population which will need more care, are intact. However, we think in the short term, this is a good time to be cautious and keep some dry powder. Despite that, we did do one acquisition in the first half. We bought 6 homes in Shropshire, a really high quality portfolio. We invested £56 million, on which we're getting a yield of 7%. Delighted to say after 5 months of owning those homes, they're performing way ahead of our expectations, which were already quite demanding.
Finally, looking at your asset management strategy, how's it going?
This is one area where we are less cautious and want to be more ambitious. So during the first half of the year, we committed £10 million to 4 projects at 4 homes. Today, those homes have 197 beds. When we complete these projects, we'll increase the number of beds by 70 to 267. We'll increase the number of good quality ensuite bathrooms. The EPC ratings, all those homes will be B or better, and we'll get a yield of over 8% on our capital, so that's very attractive. But it's not just about the money. The thing about asset management is everyone benefits. The people who live in the homes, the residents, the staff, our tenant, and we as landlord. We have 19 asset management projects at various stages in our pipeline. We're looking at how we can accelerate them because we think this is the best way we have to create value in the broadest sense, not just financial, but also social impact across the portfolio. And at the moment, in these very challenging times, we think what we should be focusing on is maximizing the value of the portfolio rather than always thinking about how to grow it.